Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Palantir.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we jump into the fascinating tug of war happening with Palantir today, June 10th, 2026, we do want to quickly mention VIP Algos.
Right, because navigating these highly volatile tech stocks requires cutting-edge tools. And VIP Algos provides exceptional algorithmic market insights.
Exactly. You can find the link to VIP Algos below in the description.
So let's get into today's breakdown. I want you to imagine something for a second. You're watching the Olympics, right?
Okay, I'm picturing it.
You're in the stadium, and a sprinter completely shatters the world record, just obliterates the competition.
An amazing moment.
Right. But when they cross the finish line, instead of cheering, the entire crowd stands up and starts booing them.
Yeah, that perfectly highlights the absurdity of the current market reaction we're seeing.
It's totally bizarre. We are witnessing this massive disconnect between physical, operational performance and the public reception of that performance.
We really are. And unpacking this glaring paradox is kind of our mission today.
Because we have a company achieving historic, hyper-growth success while simultaneously facing a brutal 26% year-to-date drop in its stock price.
Which is wild. Unpacking this requires us to separate the business from the stock ticker,
Exactly. It's a vital lesson in wealth-building context for you as an investor. Confusing a phenomenal underlying company with a perpetually rising stock chart is, well, it's one of the easiest ways to get burned.
Yeah, a pristine balance sheet and skyrocketing revenue do not grant immunity from market physics.
Right. So to understand the sell-off, we first need to establish the reality of the business itself.
Looking at their first quarter of 2026, the fundamental metrics show an enterprise operating at an unprecedented velocity.
I mean, we are talking about the fastest growth pace in the company's entire history.
Total revenue surged 85% year over year.
Which is massive.
Yeah, bringing them to $1.633 billion for the quarter.
I want to pause on that 85% figure for a second. This is their 11th consecutive quarter of revenue acceleration.
And in the software industry, you have the law of large numbers.
Exactly. As your baseline revenue grows, maintaining the same percentage growth rate becomes exponentially harder.
Right. Moving the needle on $100 million is one thing, but moving it on $1.6 billion requires a colossal influx of new capital.
And the heavy lifting is coming almost entirely from the U.S. market.
Yeah, U.S. total revenue grew 104%.
But the most critical data point within that is U.S. commercial revenue, right?
Absolutely. This segment, private businesses, hospital systems, manufacturers, it's distinct from their legacy government contracts.
And that segment skyrocketed 133% to $595 million.
Which is just staggering.
That metric literally stops me in my tracks. Growing a mature commercial segment by 133% implies a mass adoption event,
Yeah, it's not just aggressive sales tactics at that point. The market is demanding the product.
And looking at the profitability, this top-line explosion is cascading directly to the bottom line.
Their non-GAAP net income soared 153% to 33 cents adjusted EPS.
For those listening who might get tripped up by the financial jargon, non-GAAP essentially strips out one-time costs and non-cash expenses, like stock-based compensation.
Right. It gives us a clearer look at the actual cash-generating power of the core operations.
And taking that cash generation into account, the financial health of the business operates like a fortress.
It really does. In a macro environment where a lot of tech firms rely heavily on debt to fund their expansion,
Palantir is sitting on $8 billion in cash and U.S. Treasuries.
with near zero debt.
Zero debt and $8 billion in the bank. That allows a company to completely dictate its own terms.
They don't have to worry about refinancing at higher interest rates or, appeasing nervous creditors.
And it allows them to compound their cash flow. In the first quarter alone, their adjusted free cash flow hit $925 million.
Which translates to a 57% margin.
Let's talk about that because software is unique.
Right. Once the core infrastructure is built, the cost to deliver it to the next customer is negligible.
Exactly. So a 57% margin means that for every dollar coming in the door, more than half of it is turning into pure free cash after operating expenses are handled.
And based on this momentum, management raised their full year 2026 revenue guidance to over $7.65 billion.
There's a specific metric in the financial world used to measure this balance between growth and profitability.
The rule of 40.
Yes, you add a software company's revenue growth rate to its profit margin.
And the industry consensus is that a combined score over 40 indicates a highly elite, sustainable business.
So if 40 is elite, Palantir's current score is 145%.
It's a structural anomaly.
It's like a student getting 145% on a final exam. It breaks the grading curve.
The CEO noted that the only other AI infrastructure firms pulling those kinds of numbers are hardware giants like NVIDIA, Micron, and SK Hynix.
Right. But those hardware companies are selling physical processors, the literal picks and shovels of the AI build-out.
Exactly. Software providers typically struggle to prove an immediate, tangible return on investment that justifies such massive enterprise spending.
Which pushes us to ask, what exactly is driving this commercial panic buying?
Because companies do not hand over hundreds of millions of dollars unless the software solves a catastrophic bottleneck.
Right. The underlying engine here is their artificial intelligence platform, or AIP, and the ontology framework.
So we can think of large language models, the conversational AI interfaces from companies like OpenAI or Anthropic, as a raw, highly educated brain.
Okay, a brain.
Yeah, they can process text, write code, reason through logic, but a brain floating in a jar cannot move any physical muscles.
Ah, I see.
Palantir's ontology framework acts as the central nervous system.
Meaning it connects the reasoning capabilities of the AI directly to a company's real-world actions.
Exactly. It connects to their highly governed, incredibly messy operational workflows.
Let's ground that with a tangible scenario so you guys listening can visualize it. Imagine a massive global supply chain company. The AI brain might know that a hurricane is approaching a key shipping port.
Right. It can read the weather data.
But without the nervous system, the AI doesn't know which specific cargo ships hold the company's most perishable inventory.
It doesn't know the phone numbers of the ultimate truck drivers.
Exactly. And it definitely doesn't have the security clearance to reroute the shipments in the legacy software built back in 2005.
That's where Palantir comes in. They build the digital map of that specific organization's reality.
Because generic AI models are trained on the public internet. They have no concept of a corporation's proprietary classification system.
Or their hidden data silos, or their security protocols.
And once AIP integrates all of these disparate data streams, the system is exceptionally sticky.
Very sticky. The top 20 customers average $108 million in annual revenue per account.
$108 million per account.
Yeah. That figure is 3,500% higher than their average non-top 20 customer.
Wow. And existing customers actually accelerated their spend by 50% in the first quarter alone.
The pipeline of interest is successfully converting into locked-in, durable contracts.
Right. Their U.S. commercial remaining deal value, often referred to as RPO, or contracted backlog, hit $4.92 billion.
Which is a 112% increase.
But wait, the momentum isn't just commercial. It extends into their legacy government sector as well.
Yeah, the Maven Smart System is officially becoming a Pentagon program of record.
And the Department of Defense is seeking $2.3 billion over 5 years to fund it.
Earning the status of a program of record in defense contracting creates a nearly impenetrable moat.
Right. It secures a dedicated recurring line item in the federal budget.
And effectively locks out competing software vendors for years.
Okay, but I want to push back on the sustainability of the commercial moat for a second.
Sure, go ahead.
If foundational models from Anthropic or Google continue to evolve and they become exponentially smarter and more autonomous.
You're wondering if they'll cut Palantir out.
Exactly. Couldn't the creators of those brains figure out how to build their own nervous systems? Like, OpenAI could simply develop an enterprise integration layer and bypass Palantir entirely.
It's a valid question, but building a smarter brain does not inherently solve the problem of enterprise data integration.
Why not?
Well, Palantir has spent 2 decades embedding itself into the most secure, fragmented, and complex data environments on Earth.
Starting with intelligence agencies.
Right. Mapping an ontology requires understanding human organizational behavior, untangling decades of poorly written legacy code, and ensuring military-grade data governance.
So it's not just a coding problem.
Not at all. Tech giants building language models are focused on computing power and general intelligence. They aren't interested in the unglamorous, bespoke consulting work required to connect a warehouse inventory scanner to a corporate finance dashboard safely.
Ah, that makes a lot of sense.
Okay.
So turning toward the future, there are several imminent catalysts that could test this thesis.
Analyst sentiment remains surprisingly bullish on the fundamentals.
Yeah, Rosenblatt recently maintained a buy rating with a $225 price target.
specifically citing the strength of the ontology framework.
And Loop Capital reiterated a buy with a $220 target, pointing to the sustained AI-driven revenue acceleration.
Wedbush is even higher, maintaining a $230 target and labeling the company the gold standard of the industry.
And beyond analyst targets, Palantir continues to prove the adaptability of their system.
Like what happened on June 4th.
Right. They launched a proprietary AIP platform in partnership with Kirkland & Ellis,
Designed specifically to transform private equity fundraising.
moving from defense logistics and heavy manufacturing into high-end legal and financial workflows. That demonstrates the universal applicability of their software.
Looking at the next 3 months, the most significant catalyst will be their second quarter earnings in early August.
The market will heavily scrutinize whether the U.S. commercial revenue can sustain that blistering 120+% growth rate.
And investors will also be watching to see if that massive $4.45 billion contracted backlog is actively converting into recognized revenue on the income statement.
There are also ongoing rumors regarding deeper cloud integrations with Microsoft Azure and AWS.
Building on the framework of their existing Google Cloud agreement.
Furthermore, with their market capitalization stabilizing above $375 billion.
Speculation is mounting regarding potential inclusion in additional major market indices or ETFs.
Which would force institutional buying.
Exactly. But we have to pivot here. We've established the flawless execution of the underlying business, the stickiness of the product, and the catalysts.
Right, but we must now look at the technical realities of the stock chart, because the price action is painting a very different picture.
As of today, the stock is down 26% year-to-date.
Trading right around $132.07.
Technical analysis reveals specific battlegrounds between buyers and sellers right now.
The stock currently has psychological support floors sitting at $135 and $125.
And a support floor is simply a price level where, historically, enough investors step in to buy the stock.
Believing it has become a bargain.
Right, effectively halting the downward slide.
Conversely, the 50-day moving average is acting as a severe resistance level, or a ceiling.
The 50-day moving average plots the average closing price over the last 10 weeks.
And when a stock's current price sits below this line, institutional trading algorithms view the short-term momentum as broken.
So anytime the stock rallies and touches that average line, automated algorithms trigger sell orders,
knocking the price back down. The technical structure remains bearish until the stock can secure a conclusive high volume close above the $160 mark.
The timing of these drops exposes the market's underlying fear, though.
Oh, absolutely.
Right.
When the company reported the massive earnings beat we detailed earlier, the stock immediately plummeted 14%.
And then on June 9th, the moment Anthropic released a new, highly capable AI model, Palantir stock plunged again.
These movements indicate hypersensitivity to broad AI sector news and valuation concerns,
rather than anxiety about Palantir-specific operations.
The term valuation reset perfectly captures that earnings drop. Which brings us to the bear case and the sheer weight of expectations.
Palantir currently stands as the most expensive stock in the S&P 500.
They are trading at 72 times sales and roughly 105 to 110 times forward earnings.
Forward earnings represent Wall Street's projection of the company's profits over the next 12 months.
So paying 110 times that projected profit requires an immense amount of optimism.
But framing it as 72 times sales provides even starker context.
Explain that for the listeners. What does 72 times sales actually mean in practice?
Well, if Palantir took 100% of its revenue, not its profit, but every single dollar of sales coming in the door.
Okay, top line money.
Yes. And they distributed it all to shareholders as a dividend, it would take 72 years for an investor to recoup their initial purchase price at these levels.
Wow. 72 years just to break even, assuming they gave you every dime of revenue.
Exactly. When a stock commands that kind of premium, it is priced for perfection extending a decade into the future.
So the market is not paying for Palantir's performance in 2026.
No, they are paying for a reality in 2035, where Palantir has captured the entire global AI enterprise market.
Without suffering any margin compression along the way.
Right. So if a competitor merely releases a press release suggesting they might challenge that dominance, the perceived risk increases.
And the underlying business can execute perfectly. But if investor confidence wavers, and the multiple shrinks from 72 times sales down to, say, 50 times sales,
the stock price crashes.
The prominent investor Michael Burry recently issued a rare short warning on the stock, further amplifying the bearish sentiment.
His involvement highlights the inherent danger of multiple compression.
But there's another factor here. The macroeconomic environment also plays a massive invisible role.
Financial analysts point out that a soft landing scenario where inflation cools without triggering a massive recession disproportionately benefits hyper-growth names with premium valuations.
Specifically, the Federal Reserve's stance on interest rates acts as gravity on the stock price.
Now, valuing a company at 110 times forward earnings requires discounting massive profits expected many years in the future back to their present-day value.
Let me push back on that because we just said Palantir has $8 billion in cash and zero debt. So why does the Fed's interest rate policy matter so much to a software company that doesn't need to borrow money?
It's a great question. It's about the mathematical formula used for valuation, called the discount rate.
Oh, wait.
This formula uses the risk-free return of government bonds as its baseline.
So if the Federal Reserve keeps interest rates high, an investor can earn a guaranteed zero-risk 5% yield just holding cash.
Right. When the guaranteed yield on cash is high, the present value of Palantir's speculative profits 10 years down the road is mathematically crushed.
But if the Fed signals a willingness to lower interest rates,
Then those distant future cash flows suddenly become attractive again.
which typically causes high multiple tech stocks to surge upward.
So the stock price fluctuations often have nothing to do with Palantir's actual performance. They're driven by the shifting math of the discount rate.
Synthesizing the technical damage, the terrifying valuation, and the flawless underlying business fundamentals brings us to our final verdict.
Keep in mind, we are not telling you to buy or sell. We are just analyzing the data.
Right. And the consensus analysis yields a bullish score of 8 out of 10.
Palantir is recognized as a best-in-class software compounder, executing perfectly against a massive total addressable market.
But the critical caveat attached to that 8 out of 10 score is the timeline.
Yes, investing at these valuation levels requires a strict multi-year holding horizon. We're talking 3 to 5 years.
The short-term valuation volatility is too severe, and the multiple is too stretched for a shorter-term approach.
The 26% pullback year-to-date should not be viewed as a symptom of a failing enterprise.
It is a violent valuation reset.
Potentially offering an entry point for those with the patience to endure the volatility while the company's land and expand strategy plays out over the next half-decade.
Today's analysis illuminates the stark difference between market hype, which inflates valuation multiples to precarious heights, and contracted backlog.
Which proves the actual real-world demand.
Understanding this distinction is critical for you when navigating volatile sectors. But it also leaves us with a profound, lingering question regarding Palantir's ultimate trajectory.
If Palantir successfully achieves its mission over the next 5 years, becoming the undisputed central nervous system for the Pentagon, major hospital networks, and the Fortune 500,
they will possess unparalleled visibility into the operational mechanics of the entire global economy.
the efficiency gains would be staggering.
But at what point does that level of deep systemic integration transform into a massive structural vulnerability?
That's the real question.
If one single company holds the keys to the operational nervous system of the world, any disruption of that system could have catastrophic cascading consequences.
Something to seriously consider as we watch this company attempt to rewire the enterprise landscape.
Absolutely. Thank you for joining us today. As a final reminder, if you want to navigate these volatile tech swings with precision, be sure to check out VIP Algos using the link below in the description.
Keep learning, stay rational, and we will see you on the next one.